There is no precedence or a playbook written to run a company like CoreWeave. And that's unique, and that's fascinating and challenging all at the same time. My job is not just risk management and to tell all the things that could possibly go wrong. My job is also to identify all the opportunities that I see for potential growth, potential optimization, potential scaling in the business. Up until now, transparently speaking, majority of the scaling that we've done is through human capital, which is not going to be the case for the company in the next 12 to 24 months. We will have to scale using other mechanisms. So the framework I kind of tell myself and I tell everybody on my team is when you're growing at the clip at which you're growing, understand, there are fires everywhere. Understand which fire is going to burn on your couch versus which fire is going to burn down your house, and focus on the ones that actually matter while keeping an eye that couch fire does not become a house fire. I wake up every day and I'm not dreading what comes at work. I'm excited because I know what we are going to do is going to yet again redefine how this industry is operating.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to the Run the Numbers podcast. Today's guest sits at the financial nerve center of one of the most explosive stories in AI infrastructure, CoreWeave. If you've been watching the arms race for GPU compute, you know the name. If you haven't, well, buckle up because this is the CFO who's helping to scale a company that's redefining what hyperscale even means. Nitin Agrawal didn't just walk into a rocket ship, he helped build the launch pad and take the company public earlier this year. Since joining CoreWeave, he's been navigating a whirlwind of funding rounds, including a blockbuster IPO, billion-dollar infrastructure bets, and a revenue curve that would snap any hockey stick. CoreWeave grew more than 700% last year and more than 200% in their first quarter as a public company. Wow. Nitin is the guy responsible for keeping the numbers real, the investors grounded, and the servers hopefully not melting off the walls. In this episode, we get into how you build financial structure when the business model is being invented in real time. We talk about capex discipline, securitizing chips, the dark arts of revenue backlog, and why incentives for billion-dollar deals need to look a little bit different than your standard rep comp plan. Plus, a few well-earned war stories from a company redefining what it means to grow in the AI age. All this and much, much more after a short word from our sponsors. Did you know that around 40% of manually processed invoices contain errors, missing data, bad codes, duplicates? And those mistakes don't just slow your finance team down, they cost you money. That's why global finance automation matters. It's not just about saving time, it's about keeping your business safe from costly errors. And that's exactly what Tipalti does. Tipalti is the serious AP solution for serious business. Tipalti automates the end-to-end payables process, handling everything from onboarding suppliers to global payouts, all so your finance team can breathe again. More than 5,000, of the world's most ambitious businesses already rely on Tipalti to make payments in over 200 countries and 120 currencies. With baked-in security and tax compliance, Tipalti gives you the confidence to scale globally without adding extra finance headcount. Give your finance team their time back. Don't let bad invoices drain good money. Visit Tipalti.com/runthenumbers. Tipalti.com/runthenumbers. Tipalti, serious AP for serious business. So if you listen to this podcast, you'll know that I am incredibly passionate about the FP&A space because that's the route I went to get to CFO. And I want to tell you about a tool that has exploded over the past few years. It's called Aleph. And I remember getting outbounded by them about 2.5 years ago, and I actually took the bait because they claimed to be able to do a demo with my live data, with me right there on the call. And so I had to see it to believe it. And it was the founder running demos back then. Shout out Albert, hope you're listening. And he connected my NetSuite and built my P&L using their Excel add-in in like 15 minutes. And I was really impressed. Since then, Aleph has gone on to raise money from some of the top VCs out there, and they've built an impressive roster of customers. Many of their customers have been on the podcast, like the CFO at Turo, 8 Sleep, and Zapier. They're all really big champions and supporters of Aleph like me. But it's not just an Excel add-in. Aleph also allows finance teams to work with their live cross-system data using Google Sheets and their web app. And that's cool because it gives teams the option to support a wide range of needs and workflows like budgeting, forecasting, and variance analysis. And speaking of variance analysis, they're doing some really cool things with AI-powered variance analysis. It basically allows you to figure out what's going on and why, and it takes the time that you'd usually spend from hours to minutes. It's really cool. So I highly recommend checking them out and taking them up on that demo or trial, just like I did back in the day. And you can learn more and get started at getaleph.com/run. That is getaleph.com, aleph.com/run. Tell them CJ sent you. A messy or missing cap table might not just slow you down, it could cost you your next fundraising round. VCs get flooded with pitches, and if your equity is confusing or missing, they'll move on fast. Fidelity Private Shares is an all-in-one equity management platform that helps you maintain a clean cap table, an organized data room, and a clear equity story. Schedule a demo at fidelityprivateshares.com, mention Mostly Metrics, and get 20% off. Nitin, thank you so much for coming on the podcast today.
Thank you so much, CJ. I'm so excited to be, and thank you so much for having me here today.
And a big shout out to Bill Koefoed, our friend over at OneStream. This guy is he's introducing me to the who's who of the CFO crew. So thanks to Bill.
Bill is outstanding. He's been a friend, mentor, philosopher, guide for me for over 2 decades now. So he's a really cool guy.
Well, congrats on all the momentum, the incredible IPO, and the history of CoreWeave. Like, I've been trying to dig into this. This is one of the most fascinating companies out there. Maybe you can just give like the 30-second overview of how the company started and like how it ended up where the puck was going.
It's an absolutely incredible story, one that is filled with tenacity and strong conviction towards where the market is headed. In 2017, Mike and Trader, Brian McBee, Brian Ventura, they all started this company as a crypto mining company. And when the crypto winter set in 2019, 2020, they basically identified different use cases for the infrastructure that they had built. And at that time, made a decision that the infrastructure that they're building can be used for VFX and for AI use cases. And as a result of it, they repivoted the company to build the infrastructure for those use cases. And what they decided to do was to build a technology platform and an operational stack which builds a no compromises AI-first solution for infrastructure. As the AI wave started to pick up, they had strong conviction that this market and this infrastructure, is very unique, and the demand for it is going to be very, broad-based and dynamic. So as they saw the market signals, they continued to double down on their efforts in terms of procuring capacity, as well as building the technology stack to scale. And the scaling that this company has seen over the last 4 years has been absolutely incredible and fascinating, thanks to the vision that these 3 co-founders had in the company.
It's one thing to be in the right place at the right time. It's another to execute on that vision for multiple years and make true to it.
That is absolutely correct. And this is where, again, strong conviction and their unique background. Like, if you look at their backgrounds, they don't come from the conventional background of tech founders in Silicon Valley. The 3 of them are risk managers and, hedge fund managers. So the construct of balanced risk is very clear in their mind. So when they think about investing and think about building the infrastructure for the company, it's in a very risk-balanced way in terms of optimizing for outcomes that are positive and mitigating any risks that come along the way. From the way we write our long-term committed, non-cancelable contracts to how we finance that infrastructure is all very unique, which is in the core DNA of these co-founders, where they think about risk in a very different and balanced way relative to how you see some of the founders in the Silicon Valley operate on risk.
It's refreshing to hear that, because a lot of people from the outside will see a company that was growing at over 700% when they IPO'd and more than 200% year-over-year growth in Q2 is like, damn the torpedoes, like this is a riskless proposition, like we're just going for it. But like that must be a really cool mindset for you as a business partner, as their CFO, to say like you've thought through these things.
100%. And, as I was initially considering this move and joining this crazy rocket ship that is CoreWeave, that was one of the constructs. I spent a lot of time with Mike Intrator, the CEO and co-founder of the company, Brian Venturo, our chief strategy officer, as well as Brendan McBee, who's a chief development officer and the co-founder, in terms of understanding how they think about scaling and building this business and how they think about risks that exist in the business today and risks in the business as they scale this to call it, 10x, 20x of where the business was at the time. And one thing that became very clear to me in those, conversations with them was the way they think about the business is a structurally different way in how the infrastructure and the cloud buildup of the early 2000s happened, both from a technology standpoint as well as from a financial standpoint. The second thing that became very clear to me was how they think about the demand in this market and the signals, how they're evaluating them, and then assessing in a risk mitigated manner on how to scale according to those demand signals. Both of them were incredibly fascinating constructs for me to kind of come work, and coupled with my industry background, like I'm somebody who you would call as born and brought up in the cloud. From the early days of Microsoft when they were transitioning to cloud, to the hyperscaling of AWS, to most recently from Google Cloud. Like cloud is one thing that I know. So I felt very comfortable joining, this band together. And I said, if there is an infrastructure that the AI companies need and can be built at the scale that it is needed, CoreWeave is sitting at the front and center of it to lead that effort.
Well, Nitin, you bring very valuable playbooks to the table when it comes to being a finance leader growing really fast. But this is like speed we haven't seen before. And between your IPO, you've done multiple acquisitions, big ticket customer wins we see in the headlines. It's like you're scaling at the speed of light. How do you create structure when the pace is this chaotic?
That is an incredibly fascinating question, and candidly one that I wrestle with and keeps me up at night every single day. There isn't a playbook written for the kind of growth that we are seeing. And the world has seen some element of this hyperscale growth in consumer, in enterprise SaaS to some extent, but it has never been coupled together with the capital intensity and the balance sheet requirements that this infrastructure build has. When you couple those factors together, there is no precedence or a playbook written to run a company like CoreWeave. And that's unique, and that's fascinating and challenging all at the same time. So what we have had to do is to build scaffolding systems, scaffolding infrastructure, people in place while we build for the long term of the company and continue to support both new and unique constructs that are coming in the business, as well as making sure that we stay compliant for everything that we need to do as a public company and build those. There is no silver bullet that kind of gets you there, but what I find helpful in this construct is thinking about agile, iterative processes. I tell this to my team often, that don't let perfect be the enemy of good. Implement good process, good system, good mechanism, and then iterate and improve on that at a rapid clip. And that's something that I've found is incredibly helpful alongside with getting the right people on the bus in terms of, going where this trajectory of this rocket ship is going. And what I mean by that is you need people who've seen scale, you need people who've seen scrappiness, but you also need people who have the tenacity and the mindset to take from point A, which is scrappiness, to scale. And oftentimes you find people who've done one or the other or both, but do not have that tenacity to go through that process over and over again. And one of the cultural things in our company, which we kind of feel proud about, is that, working together as a team for a wholesome thing being greater than the individuals. And that is something that I think is core to, whatever we do at CoreWeave. And that's also true for the finance team that we are building here.
There's such a golden nugget of truth in what you just said there, Nitin, about Like what makes somebody scrappy is their willingness to do things that don't scale, which is antithetical to the hypergrowth scaling that you need to do. So like to be able to do both of those things when needed, like that's a very rare person to find.
It's a very rare person to find. And I keep telling my team this on a practical daily basis that, look, think about what process you need today and build it. But then as you build it, also know that what you're building needs to scale to 10x, 20x of that number or that mechanism over a period of time. And that period of time is probably in the next 6 to 12 months. So think about that mindset. And that's amazing. Like, when you give people that freedom and they understand and they come and see, and part of it, I have to admit, like it's a self-selecting process where, folks who decide to join us, they're excited about this. They're like, holy crap, like this is interesting. I'm going to be challenged in ways that have never been challenged before. I'm going to build something that is going to be unique. I'm going to go do things that in the normal course of in my career, it will take several years for me to kind of learn and go through, where in this company, I'll go through that in a matter of months. So people are excited to come join and kind of be a part of that journey where they are building something from ground up, they're scaling it, and they're doing it in not just one vector, but are doing it in multiple vectors, which across a normal company takes several years. Like, you mentioned about like things that we've done post our IPO, when companies go public, the next 12, 18, 24 months are pretty much all stabilizing the company as a public company. In our case, we're not just doing that. We've completed one acquisition. We've announced an acquisition. We've completed 2 high-yield debt issuances. We've completed 1 asset-backed financing facility. And, we've signed multiple 10-figure contracts with customers, all in the 6-ish months since we've been a public company. And that's incredible. That's fascinating in terms of what we are doing and how we are scaling. And more importantly, scaling in a manner that is unprecedented at the rate, at the clip at which, things happen in the industry.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Are you running a small or mid-sized business? Then you need more than spreadsheets or basic tools. You need Sage Intacct, the all-in-one cloud platform for accounting, ERP, and financial management. It's built for businesses like yours across industries like retail, financial services, logistics, tech, professional services, and more. Sage Intacct outperforms QuickBooks, beats NetSuite on flexibility, and delivers fast ROI, up to 250% with payback in under 6 months. Rated #1 in customer satisfaction for 8 straight years. That's not luck, folks. It's Sage Intacct. Check out the Sage Intacct financial management platform using the link in the show notes below and take control of your growth. This episode of Run the Numbers is brought to you by Mercury, business banking for founders and finance pros who want their financial stack to actually work together. Now, I don't plug tools I don't know or intimately use. I've been a Mercury customer for a couple of years now. In fact, I showed the Mercury dashboard to their CFO, Daniel Kang, from their finance team right before we hit record on this episode. It felt like a full circle moment. And what I love most is that Mercury isn't just banking, it's operational confidence. I can send a wire to a podcast editor, I can check capital balances, and I can approve a payment for a freelancer who helped me with a tech stack report, all without bouncing across tabs or praying a PDF exported correctly. Mercury's making a bet on builders. Whether you're issuing your first invoice or wiring 7 figures for a warehouse build-out, it's banking that scales with your ambition. Visit Mercury.com to apply online in minutes and see why over 200,000, entrepreneurs choose Mercury to run their business finances smarter. Here comes my banking voice. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group, Column NA, Evolve Bank and Trust, members FDIC. The IO card is issued by Patriot Bank, members FDIC, pursuant to a license from MasterCard. All right, I got to get up on my soapbox for a sec here. Everybody's talking about AI-powered this and automated that. But here's the thing about revenue recognition. It's not just about moving data around. It's about getting it right, full stop. So RightRev is laser focused on one thing, RevRec that auditors actually trust. See, there's a difference between automating revenue processes and automating revenue recognition correctly. RightRev was actually built by the godfather of RevRec, who understands ASC 606 compliance, audit controls, data validation, and the flexibility needed for complex B2B contracts. We're not trying to be your billing system or your ERP. We're the revenue recognition engine that sits between your contracts and your financials and making sure every dollar is recognized correctly, on time, every time. Companies like Snowflake and Logic Monitor don't just need fast revenue reporting, they need revenue reporting that's audit ready from day one. And that's honestly where RightRev shines. And what I love about RightRev is they're not out there trying to be everything to everyone and just slap some, AI slop on top of it. While everyone is building these massive platforms that do everything in a kind of mediocre fashion, RightRev does one thing exceptionally well. They make sure your revenue recognition is bulletproof. Ready to stop gambling with your RevRec? Visit rightrev.com to see how we make complex revenue simple. That's rightrev.com, where revenue recognition actually works. Here's a slightly weird one. So I was reading through your last earnings call. Great job, by the way. 207% year-over-year growth in Q2. That's wild. But how do you balance the optimism that comes with numbers like that to keep investors grounded in reality?
That's a great one. And that's one thing I would say, look, it's work in progress. And the piece that I found which helps us in this construct is transparency, both in terms of risks and opportunities, both with your sell-side analyst community as well as your buy-side analyst community, in terms of being very transparent and articulate around factors that contribute or may contribute both towards upside as well as the downside elements associated with it. So one of the things that we keep talking about, look, we are structurally supply-constrained environment where demand far outstrips supply from our perspective. And that's a stand that we've continued to maintain for an extensive period of time. And that's something, if anything, is not easing out anytime soon. And now the industry is kind of finally getting to the point where they're recognizing that as well. But for example, we give out a metric, on our quarterly earnings call in terms of the active power and the contracted power that the company has and how we think the directionality of that active power is going to happen. And again, the biggest constraint being powered shell capacity from a data center perspective that limits us. We've also communicated that these incremental power chunks in terms of powered shell capacity is lumpy. It comes in step functions, and even a slight delay, a 2-week delay or a 2-week pull-in has a material impact on the output of our financials, given the scale at which we are growing. If we were a normal company growing at 20-30% year on year, it probably wouldn't matter if things are 2 weeks plus or 2 weeks minus. But in this case, when you're growing at the scale at which we are growing, for example, at the end of Q2, we had announced that we have 470 megawatts of active power. And by the end of the year, we are going to be greater than 900 megawatts of active power. So think about it. Life to date, the company has deployed 470 megawatts of active power, and you're going to nearly double that in the remaining 6 months of the year. That's a gargantuan scale in terms of how you're scaling the organization and a company. And to your earlier point, it's all about execution. Portions of that execution are well within our control, and those are ones we shine upon, which is, once the powered shell capacity is available to us, delivering a highly performant infrastructure in the hands of our customers, which is both more reliable as well as more performant than the next cloud that's available out there. However, there are certain elements in terms of the availability of powered shell capacity. It's not in our control, and we are reliant on our data center provider partners for us to be provided with that. And oftentimes, they could be early or late because they're going through the same supply constraints and execution challenges to build at the scale. So having that transparency in terms of making them understand the variables that go from one direction to the other that impact how you think about financials and how you think about your guidance is critically important. But as I said, it's a work in progress. And we continue to work with the sell side and the buy side analyst community on our side in terms of helping them be educated.
So we spoke to Ed Park. He was the first FP&A hire at Facebook under Mark Zuckerberg. And he described his job, Nitin, as staying ahead of the capex to keep servers from literally melting off the wall. And this is the best analog I could come up with for your business. It feels like your world right now. How do you manage the power and the infrastructure demands that you described that come with scaling data centers at this pace.
No, 100%. And again, like if you probably would have read when, Sam was talking about, GPT-5 launch, he was basically using this analogy and saying like his GPUs are melting because they're kind of working overtime from that perspective. Structurally, all our customers are basically clamoring for capacity and asking for incremental capacity in a supply constrained environment. As we think about our capital deployment strategy, it comes in two vectors. We put our at-risk capital for the longest, lead time element, which is effectively powered shell capacity in terms of data centers. However, we're very thoughtful and diligent about not building the infrastructure that goes within the data center on a speculative basis. This is where, back to our original conversation around how the co-founders think about risk mitigation and risk management in this business is very unique. We're not in the business of speculatively building infrastructure in a philosophy of build and they shall come. Even in this highly demand driven or supply constrained environment, we're not in that business. What we do is we effectively try and get the infrastructure, which is the powered shell capacity, which is the longest longest lead time item, ahead of time, such that we can then go write long-term committed customer contracts. And then once we have those long-term committed customer contracts in hand, that is when we commit to the capital, which is the majority of our capital spend that goes within the data center, in form of the GPUs and in form of the networking equipment that goes to connect those GPU to a fabric. And that is how we think about balancing risk in our portfolio, where the longest lead time item, which is powered shell capacity, which again goes back to the contracted power that we have, that is where we put our at-risk capital based on the demand signals that we see in the market. Once we have that, which at the end of Q2, we announced we have 2.2 gigawatts of contracted power capacity. So a lot of runway for us to continue to grow beyond the 900 megawatts of active power footprint that we'll have by the end of the year. So a lot of runway still, but we continue to add to that portfolio as we see market demand. And then the second thing is once we have that capacity secured, that is when we go sign long-term committed customer contracts, based on which we then invest in terms of the GPUs and the networking equipment that goes in the data center. Financing for those is a very unique construct that, again, given the deep capital market expertise that our co-founders have, we have a very unique risk mitigated manner in which we do that. We're not, again, investing speculative capex. The fundamental, infrastructure build that is within these data centers, which is the GPUs and networking, is done through what we called as these delayed draw term facilities, which more look like ABS facilities, which have effectively multiple things that go inside there. The GPUs that are being bought associated with this debt are collateralized. The long-term committed customer contracts, their cash flows are used to amortize and pay off the interest payment associated with this debt within the four walls of the committed customer contracts. So you can think about this. You've signed a committed customer contract with an end customer, which commits for, on an average 4 to 5 to 6 years. Like those terms are also expanding for us, as we see in the market for that time period, for that particular infrastructure. And within that, term of the contract, we're able to amortize and we're able to pay the interest on the loan associated for buying the capex or associated with the capex for the GPUs in that time frame, with excessive cash flows coming back to the parent in terms of free cash flow. So within the four walls of the committed customer contract, we are able to fully pay off these GPUs. And that's a beautiful risk mitigated manner in order for us to scale and build this infrastructure. Now, where it's, this construct that we first brought to market about 3 years ago or so, the reason why this has not been replicated, in the world of finance and Wall Street, you come up with a new great structure and everybody wants to replicate that. The reason why this has not been able to replicate, across other industry players yet is two things. Number one is the quality of the customer contracts that you sign the customers with. And B, your company's own demonstrated ability to execute against it. When a debt holder, when a creditor is underwriting such facilities, they're not just underwriting a bunch of GPUs. They're kind of useless from that matter. What they're underwriting is the ability for CoreWeave to deliver against the long-term committed customer contracts. And we've demonstrated that time and again that we have that capability. So they're underwriting the whole product itself associated with what CoreWeave is selling to the end customer and knowing that we are the best in class. Semi-Analysis did a great study where they did this evaluation of all the cloud providers in the GPU space, neoclouds as well as the traditional hyperscalers, and they came back with only a single player in their platinum bucket. This is their cluster supermax ratings, and that was CoreWeave. And that was done through an extensive evaluation of what the technology stack looks like, how it operates, what's the reliability of that stack, and what performance do the end customers get on similar size clusters across different cloud providers. And that's a unique testament to our ability to not just execute against those contracts, but a differentiation of our software platform that we've built over the years, which allows this AI cloud to scale.
And this is like the game inside the game, because I'm just learning that just like anything can be collateralized or securitized if it's of value. It sounds like you've looked at using chips as collateral to actually improve your cost of capital.
100%. And again, as I said, this is not just the chips. The chips alone are value, but what is value to the end customer and these creditors is effectively the cash flows that these chips can generate. And those cash flows are effectively governed by these long-term committed customer contracts and CoreWeave's demonstrated ability to deliver against those. We were the first ones to market with the Hopper series at scale, H100s, H200s. We were the first ones to market with the Blackwell series at scale. And, most recently, we published a blog as well in terms of talking about quantifying the difference in terms of the performance benefit that end customer gets on our platform. So think about running a similar cluster of a similar size and scale with another cloud provider, and you generally get 20 to 30% higher benefit in terms of performance if it's a CoreWeave cluster. And that performance benefit from an end customer perspective means A, lower TCO, B, faster time to market for their products because they can train their workloads faster and get onto the market faster. Or if it's an inference workload, serve more of the customer base with the limited pool of capacity that they have. Sam said this multiple times, a bunch of other AI players have said this multiple times, where the growth of AI is today constrained by the amount of compute capacity that is available, to serve the needs for those AI applications and workloads.
I want to transition to talk about financial storytelling here and how you communicate the trade-off between growth and losses to investors. So what metrics, Nitin, beyond traditional P&L do you emphasize? Is it utilization, committed contracts, revenue backlog? How do you look at that?
Yeah, so a few things that, we talk about is from a profitability standpoint, the core fundamental unit economics of our business are incredibly strong. We've talked about this, in our, prospectus in our registration document, and we continue to demonstrate that on an adjusted operating income basis, we are a profitable company, so we generate that. What we tend to focus on with the investors is a few things, our adjusted operating income, which is the core measure of how we are operating at scale and how we think we can generate operating margin in the business, is something that is key. When we think about cash flows, this is a capital-intensive business. Our adjusted EBITDA margins are something that we focus, with our investors as well. And then when we talk about scale, we talk about a couple of things. One is the scale that exists today in terms of the base that is generating revenue, which is our active power. Then the second is the scale to where we can get in terms of supply that's available to us. That is effectively, our contracted power. We'd also then talk about our revenue backlog, which is the backlog of customer contracts that we've written and are committed, but the revenue associated with them has not yet been delivered. That is an indication of what revenue stream is already committed against, in what percentage ratio. We also disclose, the amount that's going to be recognized as revenue from this revenue backlog in the first 24 months, 24 to 48 months, 48 to 72 months, and thereafter. So our investors and our analyst community can get a sense of how you think about, the revenue backlog converting into revenue over a period of time. So you talk about the current execution, which is the power at scale that's kind of like deployed or active. You talk about the growth potential that's available to you, that comes online, which is your contracted power. You talk about how much of that contracted power is kind of already contracted in terms of customer commitments, which is your revenue backlog. And then you talk about how that revenue backlog shapes up as revenue for yourself over a period of time. We also talk about capex because, again, this is an investment build-up. We're building infrastructure for the next generation AI workloads. The beauty of our business model is, last quarter, 98% of our revenue was through what we call reserved instance, which is take or pay committed customer contracts, which effectively means the customers pay us for the contracted capacity irrespective of the end utilization at their end. So our business model is very robust and very unique in that construct where we're not subject to spot price variability that may happen in the market. We're not subject to the variations at end customer utilization that may happen. What we are subject to is effectively our ability to serve against those long-term committed customer contracts, which once deployed at scale, continue to generate revenue through the life of the contract. So, those are constructs that we try and work with our, sell-side analysts, our buy-side community in terms of making them understand the holistic economics of our business.
Well, I have to say, for a company growing as fast as CoreWeave is, the Q2 revenue guidance you gave of $1.06 billion to $1.1 billion, that's really tight. People often focus on not missing guidance, but there's risk in overshooting it too. So how do you think as a CFO of a publicly traded company about the credibility when it comes to that upper bound?
Yeah. So look, I think both upper bounds and lower bounds are equally important, especially, for any company, but even more so for, a newly public company. And I think the risk balanced approach that, we've taken as a company is to ensure that we communicate where the boundaries within the tolerance limits of what we think are operational challenges or opportunities for us in the quarter sit. Outside that, be transparent with the community in terms of what are those variables that change vectors one dimension or the other, which for us continue to be accelerated demand for our product, as well as our ability to bring, alongside with our partners on the data center side, our ability to bring this infrastructure up online as quickly as we can. Those two vectors put together, like the demand cycle as well as the ability to execute against that demand from a supply side perspective, are things that, we want to be transparent with the community in terms of the operational boundaries tell us the best outcome is here, but these are vectors which can actually take it one way or the other outside these boundaries. And for the last 2 quarters, knock on the wood, we've been successful in terms of trying to deliver ahead of expectations and ahead of our own expectations that we've kind of delayed down, to the external world.
And I think it brings back to the point of why revenue backlog is such a critical metric in your reporting. It signals a lot about future growth and it essentially de-risks what you're up against.
Absolutely. And when you think about revenue backlog, one thing that is interesting in that construct is, look, we often sign 10-figure customer contracts. You can imagine those contracts don't fit into the very nice, healthy mold of, you have this much pipeline, 20% of that gets converted into 30 days, 60% of that gets converted into these many dates. So it doesn't necessarily follow what you would call as your conventional 90-day quarter cycle periods. So one of the things that we've been very transparent and communicative with, both Wall Street as well as our buy-side community is that while over a period of time, our revenue backlog will continue to grow, it's going to be lumpy. You're going to have periods where you'll have an outsized step function change in your revenue backlog. And you may have periods where you may have flat to declining revenue backlog because you do recognize revenue in the quarter associated with that backlog. So depending upon how many bookings or you have in the quarter, you may have a flat to declining, revenue backlog within a quarter. And that is something, given the construct of the business, is still something our investor base and our analyst community is digesting, that how do they think about that variability that comes along, which over a period of time is fine. Like we've more than doubled our revenue backlog since the beginning of the year. And that is something that, again, our trends overall that we see expect to kind of continue to happen in our business. But on a quarter-on-quarter basis, on a 6-month period basis, they may or may not be true. So it's something that we have to manage with the expectations around both, our analyst community as well as our investor community around the chunkiness of which again, as finance folks, we can all appreciate. None of us like that volatility or that variation that comes along with it. But given the nature of the industry today and the outsized customer contracts that are being written in the industry, it's just a derivative of that.
10-figure deals. You're doing deals worth billions. How do you even begin to compensate sales reps and leaders on deals of that scale?
That's a great question. And you can imagine when you're dealing with constructs like that, everybody from top to bottom in the company, including Mike, oftentimes is deeply engaged in those conversations. It's, rarely where such deals do not involve, co-founder or C-level kind of executive kind of engagement in those deals. So as you think about some of these larger deals, you have to think about them in a different bucket, which are more strategic in nature, which are held by a handful of senior executives in the company. I'm not paying Mike on commission basis when he closes it. So, from that perspective, you have to think of the structure of the deals that you write and have carve-outs for how you think about certain outside strategic deals versus what you would call as a regular deal that your sales force writes, which again are also sizable deals given the infrastructure construct of the business, but are definitely like not in the 10-figure contract zones. So thinking about segmentation and thinking about how you compensate within those segments becomes incredibly important when an outsized portion of your business comes from these mega large size deals.
Can you just drill into that? Like any other tips for CFOs out there who may be, and it's a fortunate position to be in. You're dealing with these business development deals that are like company changing, that they're so big. How would you tell them to think about incentive structures?
Yeah, so I think the biggest way to think about it is like, what behaviors do you want to inculcate in the team? What is that you're trying to go towards? Like, when we went public, one of the feedback that we got from the market was, gosh, it's great you're growing so fast, but you have a very high revenue concentration. How are you thinking about diversifying it? Very well recognizing there are not a lot of companies on planet Earth that can go ahead and write 10-figure infrastructure contract, right? So how do you then manage diversification in that construct? So we at CoreWeave have taken that feedback very particularly. And since our IPO, we've actually been very concerted in our effort in terms of diversifying our customer base, which it's not going to be an overnight exercise given the large scale deals that we write, but we have to have enough in terms of our penetration in the enterprise space, in the other AI smaller lab space, such that when those deals become of significant size, our customer diversification happens. And we've been very careful and diligent about what our strategy needs to be around those. So for instance, one of the things that we did, in the path alongside with that journey was the Weights and Biases acquisition. Weights and Biases is a very unique platform, which practically anybody and everybody doing something in the AI space, their first, thing is to go open a Weights and Biases account and use the, then to kind of fine tune their models, have their weights and, stored in those and adjust to those as they do their training runs. And that's something that, we acquired. We basically got direct customer relationship with about 1,600 of the best customers in that industry, creating a unique opportunity for us to then go sell infrastructure to those customers, as well as also understand what those customers need as a cloud platform for us to then go build that cloud platform for them. We're not building a general purpose AI, cloud. What we are building is a particularly AI cloud,
Mhm.
And in our case, what's important for us is to not go ahead and shoot for building all the services that the general purpose cloud hyperscalers have built. They've done a beautiful job building those services, and we're not in the business of competing for those. We're in the business of building the best AI cloud. And it's very important for us to then understand what it means from an end customer perspective on the services that they need on AI cloud. So coming back to the long-winded answer around the way to think about sellers in this
Mhm.
market is like, what behaviors do you want to have in your company, and then allow for those structures. So for example, in our case, we've put an emphasis on this customer diversification for a broader sales force and our ability to continue to allow for that customer base to then diversify, even though in numbers perspective, from a revenue backlog numbers perspective, it may not be meaningful yet. So identifying those vectors in your company that you don't necessarily just want for today, but also for the future are critically important. And that's what we've decided to focus on.
Let's bring it back to your team. So you're at a company with immense capex and capital market considerations. When you think about your org and the talent that you need, is it different than a traditional SaaS company if you need in a seat?
Yeah, 100%. And it comes from multiple different vectors. Number one is, like we talked a little bit about earlier, is the combination of growth and balance sheet. Like if you look at a conventional, SaaS company, the construct of a balance sheet and balance sheet management kind of barely exists. You have your expenses fundamentally in product development or sales and marketing. You don't really have a balance sheet construct. So understanding how to scale a balance sheet in a effective manner and managing risks around that balance sheet scaling, critically important for a company like ours. In addition, in order for you to fund that, you need to have a team that understands capital markets, can execute in capital markets, in a very effective manner and bring them inside the company. So we have an absolutely phenomenal corp dev team led by one of our co-founders, Brennan McBee, and they are absolute fascinating people in terms of their understanding of capital structure, and then bring those capital structures to our company in terms of the capital we raise in the market, whether it is our delayed draw facilities, which are like ABS facilities, or whether it be other capital market transactions like the high yield debt issuances that we did, after our IPO. Having those alongside with a absolutely amazing treasury team to manage the cash requirements for the company. You can imagine what it looks like, from our company perspective. Last quarter in Q2, the guidance that the company provided for full year capex was $20 to $23 billion. And when you have that much amount of capex flowing through the company, you can imagine how cash management is a very critical aspect of your business. Alongside with, when you think on the traditional FP&A side, there are more than one variable that come into construct when you're writing these 10-figure deals and working, with end customers for these infrastructure constructs that barely exist in the market today. Like anything and everything we do today kind of doesn't really have a market precedence. And the same thing goes for the accounting team. All the constructs that we are writing, which are as creative as they are and are absolutely necessary for scaling the company the way it's been scaling, create complexities on the accounting side, from RevRec all the way to expense management in terms of lease accounting and all the other factors, as well as the accounting for the capital constructs we have. It's incredibly complicated. So you need a team that can understand these variables, has had experience in dealing with more than one of the variables that we deal with, but also are agile to understand and unlearn many of the constructs that they might have learned in their prior gigs while bringing the experience from those. And that's a hard one. Like, I almost tell people, I need your experience, but I don't need you to tell me that this is how it is done, because the constructs that we are building and we're scaling are fundamentally unique and are unprecedented. So I need you to bring your most creative self in what it means to scale CoreWeave. You're forming precedences here versus, trying to pattern match against a set of precedences that you may have been exposed to. You're setting precedences here which helps from your prior experience, but you're not going to be able to find something exactly from your past experience that fits in the constructs that you're going to be operating there.
You stole the word I was going to use. Unlearn. You're asking very smart people who got to that point in their career, essentially, because they learned something so well, take a different viewpoint on it. Sometimes you have to be creative. Sometimes you have to come up with a solution. There isn't a playbook for that.
100%. And I'll kind of like put it myself like in that bucket. And I had to unlearn. And as I mentioned to you, I am somebody who I consider myself to be born and brought up in the cloud business. And many of those constructs I've had to unlearn because it's fundamentally different for the AI cloud that is being built right now. For a very long period of time, I held a very strong belief that, having the, scaling the infrastructure requirements for a cloud can only be done inside a company with bulletproof balance sheet, which is why you had the Microsofts of the world, the Amazons of the world, the Googles of the world scaling the cloud business. And here it is, CoreWeave scaling through very unique and innovative financial mechanisms, the capital intense requirements for scaling an infrastructure company at this gigantic and unprecedented scale. So a lot of those constructs, while your past experience helps you, but you have to unlearn some of them, apply certain experiences to do some pattern matching, but then understand what you're building here is fundamentally path-breaking, unique, and unprecedented.
Nitin, what keeps you up at night? Thinking about the short term or the long term?
It's both. And when I say both, it's different constructs.
Okay.
Or rather, it's a similar construct for both. It's scaling. I care about scaling for where we are today and how to think about 10x, 20x in the near future. And I also worry about how does this scale to 100x, 200x over the long term? Because that is where the industry is heading. That is where we need to kind of get to. And that scaling has continued for CoreWeave over the last 4 or 5 years. Having said that, I also know what worked for us over the last 4 or 5 years is not something that's going to work for us, in the next 4 to 5. So how do you think about scaling tools, scaling people, scaling processes, mechanisms in a public domain? Scaling those in a private environment, which many tech companies have afforded the luxury over the last, 2 decades or so, where they could stay longer, private. In our case, we went public to accelerate the growth of the company because we needed access to deeper capital cost pools, capital pools, and lower cost of capital. Mm-hmm. And that was something incredibly important for the company. So we are now a public company because that is where the right space for this company is. But in order for us to do that in a compliant manner, in that 90-day window that any public company needs to operate it, is incredibly important. So, how do we think about scaling this company for the next, several years to come? Most importantly, the first next 12 months, the next 24 months, but then beyond that, to what this company needs to be. We're here to build a generational company. When we're done and being dusted and kind of get to that point of steady state, this company is going to look very different, but it's going to be a journey for us to get there.
Well, something I riff with CFOs on the podcast about all the time is that in order to make the right long-term calls, you have to be in the guts of the business model. You have to be at that ground level and get really low. But also at the same time, because you're so in the weeds, it's harder to come up and look further out.
Well, 100%. And this is something like, look, sometimes having that knowledge and that experience is a bane and a boon. In my case, cloud is one industry that I know very well, but it also tends to sometimes be a, hindrance where, you immediately start going back to thinking about, oh, this is how I've done it and this is how it needs to be, versus thinking about, hold on, what might be different here? Why would I do something differently here than what I've done in the past? Are there reasons? Are there fundamental structures that need to be thought differently? So from that perspective, it's kind of very unique for you to think about the business on a everyday basis, see what are shorter term impacts that you are going through because of scaling versus differentiating what is longer term structural in the business. And what I tend to focus on is like, look, for the things that are shorter term and are painful while we are scaling, I'm okay to live with them for a certain period of time while keeping an eye on. What I want to be maniacally focused on, structural things in the business that may be derailing the business or have a potential of derailing the business or have a potential of materially, accretively adding to the business and making sure those are covered. So I think as a CFO, it's critically important to know what the immediate things are and whether those things are, call it short-term scaling in nature, or whether those things are structural. If they are structural in nature, you need to get on them right away and make sure that they are fixed, because those are very painful to unwind once you've scaled. They're very easy to fix when you're scaling, very painful to unwind. On the flip side, if there are things that inefficiencies that exist in the system, which are fundamentally related to shorter term scaling pains, you can possibly live with them while keeping an eye on them such that they don't go out of control. So the framework I kind of tell myself and I tell everybody on my team is when you're growing at the clip at which you're growing, understand, there are fires everywhere. Understand which fire is going to burn on your couch versus which fire is going to burn down your house, and focus on the ones that actually matter, while keeping an eye that couch fire does not become a house fire.
That is an amazing analog. Nitin, I'm going to take you into what we call our long-ass lightning round. So the first question I ask of successful CFOs like yourself is, what's one thing you've messed up on the job before?
Oh, plenty. I could be here all day, my friend, talking about those. But one thing, again, I'll share this with, on this podcast because, with other CFOs probably listening and, probably looking to take their company public, is do not underestimate the amount of education that you may have to do with the investor community, with the analyst community, if you're bringing to market a new business model which does not fit into a nice little square box that those investors and analysts are very familiar with. In our case, that was absolutely true. While I knew that that is the case, I think I fundamentally underestimated the amount of education and the hand-holding we will have to do in order for folks to understand the new business model, the new financing constructs, and candidly, the simple answer, you have $3 trillion companies as your competitors. How can you survive? How can you, CoreWeave, with 200, 300, 400 people, survive, and how long-lived that competitive advantage from a technology standpoint can be? Understanding, what you're up against and being thoughtful, especially if that construct is new to market, is critically important. I have to admit that is something that I underestimated as we went public. And it's a journey that we've been kind of traversing. We're in a much better spot now than we were 6-9 months ago in terms of the education, but it's been a journey. And if this is one request I could make to all my fellow, CFOs or aspirant CFOs that are kind of listening to this, is do not underestimate that.
If you could give your younger self advice, knowing what you know today, looking back at your career, what would you tell them?
Look, in finance, people have a tendency of being very risk focused. Like, we as finance professionals are thinking on risk frameworks all the time. Oh, there is a risk there. Oh, there is a risk there. Oh, there is a risk there. What we don't do as good and as great of a job is in terms of identifying the opportunities. So if I could go back in time and I could tell myself is to rewire myself fundamentally that my job is both. My job is not just risk management and to tell all the things that could possibly go wrong. My job is also to identify all the opportunities that I see for potential growth, potential optimization, potential scaling in the business. As I said, like in finance, there is a natural bent that comes that gravitates us more towards risk and risk mitigation than towards opportunity maximization. And if I could tell my younger self, which balance those two out, risk is something that you cannot let go of as a finance individual, but at the same point of time, tell yourself every day that my job is also to find those opportunities for the business to grow or the business to scale, identify and help the business get there. I think we'd all make great, much better finance leaders if we balance those two in our mind and make sure that we tell ourselves every day that our job is both.
That's great. Next one I got for you, more of a technical one. Can you walk me through what tools your finance team is using to get the job done today?
Yeah. So as you can imagine, we scaled the way we scaled, from a company perspective, very rapidly.
Yeah.
Our infrastructure network from a tooling perspective is still catching up. So we're still like on NetSuite as our ERP. We have some adjacent systems that kind of feed that ERP, but we are right now in our journey in terms of defining what that tools roadmap for the company looks like, and then having a comprehensive end-to-end, whether it's from treasury management to booking our journal entries, in terms of how we think about everything, to put a connected system in place, and also think about what does our ERP journey look like from here on. What's gotten us here is not going to get us for the next 2 to 3 years. Most of the companies, if you look at when you think about asset intensity, have a different infrastructure from a tooling perspective to a high growth company, which has a different SaaS kind of a tooling structure. We're both. So how do you bring the two together in terms of the infrastructure? And there are a few tools like Flowcast we've implemented that have been very helpful for us in terms of managing our infrastructure, in terms of our journal entry management and things like that. We're looking at, we talked about Bill, we're looking at OneStream and other companies like those for our holistic FP&A platform for our company. So all of that journey is ongoing for us while we continue to build and scale for what is a very unique business model alongside with an unprecedented scale at which we are building that.
And that's the piece, aside from the tools, I was most curious about, because there is no downtime, right? It's pretty hard for you to do an ERP implementation on the fly.
That is true. And that is one thing that, look, we thought about that at the earlier part of this year, late part of last year. And we punted that decision because, we were doing this small thing called going public. And as a result of it, we had to kind of push it out and say, okay, you know what, let's come down to it, because right now we just can't do that at this point of time. And this is particularly true with not just the tools piece of our business. This is true for everything that we do.
Great point.
While we are operating at this lightning speed and going 1,000,000 miles an hour, you have to not just support what that requires, but also think about what did you leave behind that you can then now scale going forward. I tell this to my team that there are two parts of your job that you have to carry. And it's not an or scenario, it's an and scenario, particularly for who we are, is to continue and accelerate the pace at which we're going today, but then also manage and think about the scale that we have and how you're going to effectively manage from here on. Up until now, transparently speaking, majority of the scaling that we've done is through human capital, which is not going to be the case for the company in the next 12 to 24 months. We will have to scale using other mechanisms, especially as we get to SOX compliance and all of those elements. It's going to be critically important for us as a company to be in those dimensions. And again, while there is no silver bullet, the way I take kind of pride and I take peace in this is we have an incredibly talented team, and here at CoreWeave, from all functions within my function, supporting IT function, business functions, which are all dedicated towards, given the culture that the co-founders have established in the company, we're excited about, building CoreWeave. We're excited about this next challenge. I wake up every day and I'm not dreading what comes at work. I'm excited because I know what we are going to do is going to yet again redefine how this industry is operating. And that's honestly exciting, fascinating, sometimes nerve-wracking, I'm not going to lie, but it's just what keeps us going as an organization, as a company, and as a team together.
I think that's a fantastic place to end this. Thank you so much for joining me, Nitin. This has been a blast.
Oh, thank you so much, CJ, for having me. It's been incredibly having this conversation with you.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.